The views expressed on this podcast are those of the participants, not of Reuters News.
Yeah, this is like the kind of big puzzle, problem with Europe is that Germany, its biggest, far away in its biggest economy, was not prepared to kind of put its fiscal foot down and, go for growth in that way. And now, because it's been shoved into it, it probably will be. And so that just changes the dynamic in an interesting way.
In a matter of weeks, Donald Trump has upended America's relationship with Europe. His questioning of the NATO alliance, as well as the warning that the US is no longer Europe's protector, is driving investors to scoop up shares in presumed winners like German defense firm Rheinmetall. Investors are also grappling with the implications of trade wars between the US and Europe. This is all changing the dynamics between Europe and the US. Europe, once a lumbering market with demographic issues that were likely to stem growth, is now looking more exciting thanks to the new German leader who plans to abandon a fiscal handbrake. How CEOs and other leaders can take advantage of the situation and its impact on companies and markets is the focus of this week's Viewsroom. Welcome back to the Viewsroom, the weekly podcast that invites you, the listener, into a lively debate about the big stories of the week. And I'm your host, Amy Donlan.
And I'm Jonathan Guilford.
So, Jonathan, the tables are beginning to turn. I think it was like before Donald Trump became president, it was pretty much every month there was a company talking about moving its listing to the US, wanting to look a bit more American. George Hay, who we're going to have on in a second, wrote about Wholesome, basically, doing something to essentially make itself look more American, which he can talk to us about. What is the view from the US? Because obviously in this scenario, it looks like Europe is becoming more appealing. There's more draw to Europe now than there is the US.
It's funny. It's sort of this monkey's paw situation, which is, I think, among a lot of folks who cut their teeth in the Euro crisis back in the 2010s, there was this constant question of when is European integration going to take its next step? When is Germany going to let up on fiscal discipline and begin spending? What's going to happen? Will Germany ever spend down its excess savings? And it's kind of like, oh, you're finally getting the thing that I think a lot of hand-wringers in the US were saying Europe should do, only for maybe not exactly the reason that everybody was assuming it would happen. Obviously, I don't think anybody foresaw like a breakdown of the NATO alliance being the driver of a European fiscal pivot. It's part of the whole weird Trump thing, though, of coming in with this America First policy program that, at least for the moment, paradoxically seems to be somewhat changing Europe's fortunes instead. I mean, is that do people seem to have an appreciation of that over on the other side of the Atlantic, or is it more still just kind of shell shock over the chaos every day?
Yeah, I mean, I think what we're seeing now is definitely more excitement in Europe about the prospect of growth, which I think was not really on the cards before. But George Hay, the EMEA head of Breakingviews, is here with us today, who has been really writing a lot of really interesting stuff about this lately, and I'm excited to hear his views on this. And Pierre Briançon, who has also been looking an awful lot at Germany, which is, I think, a key star in this story. And he is actually based in Germany. So Pierre, George, you are very welcome.
Good to be here.
Hi there.
So Pierre, Jonathan very nicely kind of pointed out the view from the US. Maybe you could explain to the listeners what exactly was Germany's idea about kind of fiscal responsibility? How was the country operating? What were the issues to do with growth? And is this basically the idea of the NATO alliance falling apart, that this now can happen?
Maybe before the turnaround that Jonathan underlined of Germany's fiscal stance, the old fiscal discipline that had been the mantra of every single government in the last decades, we have to maybe start with the real seismic shift geopolitically was Chancellor-elect Friedrich Merz on the eve of his election saying that Europe now had to do without the US. I mean, this was a turnaround compared to 80 years of, very Atlantic-minded, very US-supportive German position. The refusal of Germany to envision any form of European defense or even European strategy, and their willingness to really count on the US umbrella to protect themselves. The fact that Merz said that, and very uncharacteristically for a conservative future chancellor, was the start of the changes we saw later on, i.e., the willingness to boost defense spending way beyond any form of fiscal limit or budget limits that had been set before, and the acknowledgement, probably because he had to make some concessions to his social democratic partners, that Germany also needed to shake off its fiscal fetishism, I would say, in order to invest more in infrastructure, because this is a country.
An unusual word, Pierre.
This is a country.
I would say masochism, actually. But,
this is a country that is really whose economy is very sick, has been declining for 3 years in a row, and needs to make structural changes to the way it approaches economic and fiscal policy. So all of this stemmed from the fact that for the first time in 80 years, Germany said, okay, we have to think of a European future without the US. And that's something that explained what followed.
So before we go any further, can you just describe for the listeners what, on a policy basis, Merz has actually proposed?
Okay, what they have agreed on with his future coalition partners of the SPD, the Social Democrats that are the political adversaries of Merz, but with whom he's trying to build a coalition government. What they have agreed, without waiting, is to ask the current German parliament, whose term expires at the end of the month, to vote for a 500 billion infrastructure investment package that would be separate from the official budget, so would not count toward a budget deficit that has to be limited, according to the German constitution, to 0.35% of GDP, which is like no deficit at all. And separately, decide to exempt future defense spending from the budget rules, the constitutional budget rules, or at least, a big part of the future defense spending. This means that no number has been set on the future defense spending, although Merz has said he wants to take eventually the defense budget up to 3.5% of GDP, in line roughly with what other Europeans want to do as well. And but that will be exempt for the debt brake, which means that they can really spend a lot, theoretically, an unlimited amount on defense.
Right. And I presume, obviously, there's a lot of legislative wrangling that has to happen. But it's interesting because I think we've seen the reaction already in a lot of defense stocks, especially in Germany. And I know, George, you wrote a really interesting piece recently highlighting the kind of valuation gap between Europe and the US, which has been really stark and really wide for a really long time. I mean, coming into this moment, like, what do you think was driving that? And, like, are there actually a significant number of European companies that had similar growth prospects, maybe, that seemed comparable to US peers, but were just not valued that way?
well, yeah, I mean, for a long time, as you say, there was this. There's been a disconnect between, benchmark S&P 500 in the US and stock 600 in Europe, but that has just kind of in the last couple of years, kind of, and in the last year, gapped out to kind of really quite unusual proportions, and that's just basically. We've got to kind of rewind it back to where we were just at the end of last year, which is only a couple of months ago. But the whole vibe there was the US 2025 is going to grow at 2.5%, maybe more than that, at a national level in terms of its GDP, and the EU is just like massively down in the dumps, kind of maybe growing 1% of that, and certain its real engine of its economy, like Germany, really struggling way below that. And the assumption was just, there was a real reason for that, that disconnect. And the assumption was also that Europe was going to be stuck in this low growth trajectory, and the US was going to go towards this deregulatory nirvana with no downside from all this kind of tariff stuff, and it was going to be, and so so the upshot was that European companies really wanted to be in the US because that was seen as the growth market. But you did see you had seen some kind of disconnects in terms of, if I talk of a big European company like Santander, a Spanish bank, it's hit all its targets, doing pretty well. It's making a 15% plus return on tangible equity, not far off someone like JP Morgan in the States. The JP Morgan trades at around well over two times book, the value of its net assets, and Santander was until very recently was kind of languishing below the value of its below its book value, basically. So there's this kind of big disconnect, and that was reflected elsewhere in the wider market. And so there was this kind of what kind of interestingly started to happen, and you saw it at the beginning of the year in terms of the flows from US investors into European stocks, was that those US investors who had generally looked at Europe, pretty askance and thought, why would you ever invest there? They started to think, well, this is such a bargain. The spread is so massive. Why don't we just put some money in there? So you could sort of see that in the flows coming in. And all that's happened, I think, in the last month or so is that the stuff that Pierre's talking about there, we've gone from a situation where, Europe looks a bit of a basket case, but is massively cheap, to Europe looks like a basket case, and is massively cheap, but is suddenly doing something that might create some sort of growth. And all that stuff is very uncertain about exactly how much growth there will be, exactly what will happen next. But that's kind of explains this spurt that you've seen recently, and that's kind of what we're talking about here.
And George, I think it's really interesting. So, as you mentioned, Santander is such a good example of a company that, yes, there's this quite a big valuation gap, and then they're talking up a lot about expanding into the US. That's what they were doing, really, up until recently. Right. And it's funny because then again, when I was talking about, the listings, the companies that are considering moving their listings to the US, and there does seem to be many elements to this. One of the things they talk about is the valuations being higher in the US. Ashtead, which is this equipment rental group in the UK, was basically talking about moving their listing to the US. But we're obviously very much at the early stages of this. And as you said, we don't know really what's going to happen with European growth. But is that likely to make people rethink some of those decisions, that maybe Europe is actually where they should be expanding into, or focusing more of their investment and their capex and things like that? If you're more likely to see growth and the kind of stimulus that Germany's talking about.
Well, that's the kind of argument that I was kind of advancing last week in the piece you're talking about. I mean, it's, as I say, caveat upon caveat. Europe will still probably, in absolute terms, grow less quickly than the US. And for the reasons that we're talking about, one of you mentioned Holcim earlier. Like a year ago, they decided to kind of basically split off their US operations, because they thought, if we just create this, our investors are telling us we want access to US growth. We don't want sad old Europe. We want exciting US growth. And so they're in this process of splitting off the US business, and you might assume that business will trade on a higher multiple, and that's the kind of that's not just a Holcim thing. That's the kind of logic underpinning what a lot of European boards are thinking at the moment. But the whole point about the reason why your question is interesting is just because we may be at a slight pivot on that, because the US, as everyone can see at the moment, is picking a fight with every last country and tried to kind of slap these tariffs on its friends as well as people who it's less friendly with, and that probably will have some effects on growth. We don't really know what, but it probably will. So that would rub against this idea of US as this kind of growth nirvana. Simultaneously, as we're talking about, Europe is clearly doing. Europe, for the first time in some time, has something going for it. Something interesting happening on the infrastructure front and on the defence spend front. And as Pierre was saying earlier, this thing, this is like the kind of big puzzle, big problem with Europe is that Germany, its biggest, far away in its biggest economy, was not prepared to kind of put its fiscal foot down and go for growth in that way. And now, because it's been shoved into it, it probably will be. And so that just changes the dynamic in an interesting way. And I'm not saying that therefore, European boards will just be like, okay, no more investment in the US at all, or we're going to completely handbrake turn. Some of them are very largely exposed to the US, so they will continue investing there. But it's just at the margin that dynamic is probably going to play itself out now.
Right. And I think there are two really important points kind of embedded in what you're saying there, which is, one, the US is lashing out at allies in ways that imply that not only do you have to, make the first big splashy announcement and whatnot, you need to actually, in material terms, replace the arms and tanks that were previously made in the US that maybe you are now a little more reticent to rely on. Second point, we've been talking around this kind of, idea of Germany's role in Europe this entire time. As I said up top, I think the US view has long been that not only did Germany not put its foot down for growth, it was restraining a lot of policy that I think a lot of the folks over here at least kind of thought like, this is obviously the same way that Europe is going to go, whether it's Eurobonds or banking union or any number of things. I mean, Pierre, I'm curious, on both of those pictures, like the ability to materially replace US military support and Germany's commitment to do so, presumably supported by politicians in France, I would assume. Do you think these are realistic things to depend upon? That there is actually a chance for Europe to step into the defense vacuum, and that German metal will hold through doing that?
I think a key thing in all of what we're talking about is, and you're absolutely right, is the timeline. We're talking as if things were happening today, but we're talking instead, in reality, we're talking about promises that will take years to materialize and to turn into actual GDP, actual orders to companies, actual factories running. Let's set aside Ukraine for the moment, because Ukraine is just a small part of the EU defense project, if you want. The sums we're talking about in Germany, for example, will not be spent this year, certainly not on the defense front. So we'll have to wait further years. And then we don't know the amount, whether it's going to be 1% of GDP, 1.5% of GDP. By the way, what economists call the multiplier of defense spending generally in Europe is estimated at around 1. It's a controversial notion, but so it means 1% more of defense spending, 1% of GDP more of defense spending means growth 1% more in terms of growth, actual growth. Okay, so if Europe altogether, or at least the NATO members of Europe of the European Union, spend 1.5% more in terms of GDP in defense, that means growth will raise by 1.5 percentage points, which is really serious. If you're looking at Germany, the amount they've pledged on infrastructure and what can be estimated they will spend on defense, according, I believe Deutsche Bank had that projection, means they will run budget deficits of 5 to 6% of GDP for many years, but not this year, in a couple of years' time. This is enormous for Germany. I mean, they've never had such deficits. I mean, those are, I would say, French-style budget deficits. And it shows you, by the way, everything you can do with fiscal discipline, which George called fiscal masochism, meaning that with 60% debt to GDP ratio, you can afford to spend tons of money more when the time comes, when a big shock happens. This is not the case of France and Italy, who basically cannot improve their defense budgets on their own. They have to rely on joint borrowing. They will have to rely on joint borrowing from by the EU and all sorts of tricks to be able to meet their pledges. And so, but we are talking a big impact. I mean, big if true, as we say sometimes, in terms of both defense spending and hence GDP and growth for Europe. But as you pointed out, Jonathan, the key is time. This will not happen within the next year. It will be only tentative in the next 2 years. And then if pledges are met, if promises are fulfilled, then we can see we can see a huge boost in terms of economic growth.
I was funny, George, just to listen to all of this, it sounds so rosy for Europe and things are finally turning and growth is coming back and it can compete with the US, which is all fantastic. But there's always one fly in the ointment when it comes to Europe, which is they have to agree on things. They have to come together. And there's also the issue, I think, about political stability, right? Because France, for example, is looking particularly unstable in its politics. There's elections that can change the way things, or just even Germany is trying to sort out this coalition. I mean, again, if you're kind of thinking about Europe, is this too early really to make any kind of decisions or thoughts on whether Europe is really kind of, on a road to redemption or growth or any of those things? I mean, is this more of a wait and see that you'd be thinking if you were an investor or even a CEO that might be making decisions?
Yeah, well, I suppose you can kind of just split it out into, from an investment point of view, there's a kind of momentum behind this at the moment. There's like a kind of, Europe is really cheap and cheap for a reason. Oh, maybe it's a bit better than we thought. There's a bit of a momentum behind that trade. As to the more substantive, is the European Union going to sort itself out? Is it going to kind of rise to the challenge? You can't cover the EU as I have for over a decade and just think the answer to that question is absolutely yes, because that would be naive, and we don't want to be that. But if you have to badge it for our purposes of this conversation and where we are right at this moment, it's less about the Trump bump and it's more about the Merz spurt. So let's just focus on that. It's more interesting, right?
That's true. True. The positivity of it all.
That awful phrase, George. But
I know, it's horrible, isn't it? It does almost rhyme though.
So once again, we find ourselves on the precipice of a crisis, waiting to see whether Europe is actually going to get its house together. Maybe slightly more optimistic pointers this time than in the 2010s, but we shall see. On that note, George, Pierre, thank you so much for joining us on the Views Room.
Thank you.
Thanks a lot. Thanks.